Very good afternoon to everybody, those who are present today. It is my pleasure to welcome Dr. Olayinka Moses from Victoria University of Wellington. Dr. Moses is an academic program leader at the Wellington School of Business and Government at Victoria University of Wellington and a professor extraordinary at the College of Accounting Sciences, University of South Africa. He is a fellow of Certified Practicing Accountant Australia and a member of Chartered Accountants Australia and New Zealand. He is the chair of the CPA ESG Committee New Zealand Division and the current vice president of the African Accounting and Finance Association. His research interests intersect sustainable management decisions and financial reporting, considering, among other factors, how accountability is implicated in managerial choices and corporate sustainability reporting. Dr. Moses has been published in top-tier accounting journals such as Accounting, Auditing, and Accountability Journal, Financial Accountability and Management, Journal of Accounting Literature, Accounting and Finance, Journal of Contemporary Accounting and Economics, and several other such reputed journals. Additionally, he holds influential editorial roles in several journals, contributing to the dissemination of knowledge and the advancement of the accounting profession. Dr. Moses, we are very happy to welcome you. Thanks a lot for accepting our invitation. We'll be very happy to hear your views today. Dr. Moses is going to talk on strategic choices and ESG performance. Should managers be concerned about the unintended or intended consequences of the strategy typology? Before I hand it over to Dr. Moses, a request to the audience, if you have any questions, please wait till we are done with the formal presentation, and then we'll have enough time in hand for you to ask questions, right? With this, I welcome Dr. Moses again and hand it over to you.
Thank you so much, Professor Neerav, and thank you, Professor Anish, as well, for this kind invitation. It's an honor to be with you from New Zealand. I was just joking to say it's daytime there, but it's night here. So Neerav knows the story very well. Okay, I will start by sharing my slide. Let's see. Let me know if I should share this in a second, but just double checking. All right, is it sharing now?
Yes, please go ahead.
Excellent. All right, so thank you so much. And very much like the center, the Arun Duggal Centre for ESG Research, I think it's a little bit like our ESG committee here, which sort of interacts with a mixture of industry, business practitioners, and academics. So the way I'm going to pitch my presentation is really in that middle ground where hopefully we cut across professionals and academics. But it would be good to know who is on the call. So we've got a quick poll. If it's ready, let's see if you can just quickly click on the poll to know. Let's know if you're a professional member or a business person. Oh, thanks, yeah. Whether you're an academic or a business or a professional. So we'll see. It's going as we thought. Yeah, very close lines. Okay. Interesting. So I can share the poll if you want, but what I can see here is we have 48% professionals and about 50, 54, 55% or 57% nice changing, 57% academic. So around that 50-50 mark. So beautiful. So the talk will really speak to decision making from a business perspective. But again, I will inform it from the research we're doing. And this research, of course, I'm presenting, but is together with our colleagues here from Victoria University of Wellington. So I've got Ainu, Dr. Einul with me on this project. I had Tony Van Zyl, Professor Tony Van Zyl, and Edacha Michael, who is also perhaps on the call somewhere. So we've been working on this project, and this is part of the research we'll be sharing. I'll be sharing as part of the ongoing findings. So the real topic is strategic choices and ESG performance. Now, the other part is a question. Should a manager really worry about what type of strategy they apply? And if they do worry, which one should bother them the most? Is it the consequences of the strategy type on ESG performance, or the consequences of the strategy on just achieving financial results? Now, we're going to answer that question empirically, and I'll give you some reasons why I'm sharing the result now, just in case people want to see. 48%, 55 is how we track on. So I'll close it now, which is nearly everybody answered. Okay. Right. So we're going to have a quick chat, and then at the end, maybe this time we're going to have good question and answer. So just setting the scene, I mean, the question about why should people or why should a business bother about ESG? It might sound very rhetorical. In other words, it's so obvious. People know how important ESG is, and that's true. But it's one thing to theoretically know what it means, but it's another thing for businesses to link that implication to their everyday transactions. And that's what we try to do here. There is no debate about it that ESG issues have become really top issues around corporate performance. There are several factors driving that. We don't discuss that in the paper here, but very classical things would be the demand from stakeholders. There is regulation on the way coming. Then you have to also deal with competition in the market. So what type of business are you running, and what kind of customer network do you want to build? So those things have been well documented. In a paper that we just recently published, we looked at what CEOs of the ports authorities or ports in New Zealand consider as being main driver for their ESG performance. And those kind of classical answers came up. It was more about legitimacy, getting their social license in the market, getting stakeholders to buy into their strategy, and even competing for what you call green finance, where investors want to only give money to companies that they believe are trying to operate within that ambit of what they call responsible business culture. And looking at that perspective, there is a lot of money now sort of chasing what we call climate risk or climate responsible investment. So, and if you're a portfolio manager, if you're a portfolio investor, if you're an institutional investor, you might be saying, I have people who give me money, and what they want me to do is to invest in companies that will specifically achieve certain outcome. So they want to put their money in a business that would also deliver returns, but in doing that, the business must also solve a societal problem. So it could be a business that takes diversity as a strong factor in its employment, or it's a business that sort of respects the services of its workers. So it's trying to eliminate anything you're going to call modern slavery within its supply chain. And it could be the very fundamental one that companies are worried about today, which is businesses that decarbonize or reduce the greenhouse gas emissions within their carbon footprint or within their supply chain. Now, all of this means if you're a business and you're seeking funding, or you're trying to even price your risk, then you've got to think about how all these factors play out. So really, the question as to why we should bother about ESG, I guess, is well debated, and it's perhaps resolved on the positive side that it holds significant consequences for business operations. And there's even more evidence to the fact that if you look around, we've got the International Accounting Standard Board released the just two recent S1 and S2, which is the IFRS sustainability standard last year. And gradually, what we're seeing now is an uptake in jurisdictions committing to, the sustainability standards. And what we're going to see going forward is either mandates will now kick in, or companies who operate in certain jurisdictions where those IFRSs have been adopted will be required to prepare financial statements that meet those requirements. So, in sort of a bit of a wrapping up to this question, one can conclude that, given all those things we know happening around this whole ESG space, every new knowledge we can get, every new insight we can gather as to how ESG performance, is impacted either by the idiosyncratic properties of a firm or its managerial choices, it's going to be very important. And I'll speak more about why strategy even matters. Several reasons explain it. One of the courses I teach is strategy and value. And we talk about strategy and business value and performance. So I spend time really trying to explain what strategy means and how it sort of plays out in business operations in class. But beyond that, even in terms of my other role with the professional association here, is in sort of providing guidance or sort of support to the business performance paper that is written at the professional level. And all through, what is very strong is that accountants are constantly faced with strategic decision-making tasks. And so as the more we know about how those decisions can play out in our everyday operations, the better for us. And ESG is one of those things that matter. But ESG is one thing. The core of the question is, how does business strategy impact ESG? And let's see if we can build some link or linkages into the conversation. Now, I guess typical academic style, it's always good to start with an introduction, at least at the minimum. How did we conceptualize business strategy? Well, in its simplest form, business strategy really deals with what you can call the competitive advantage a firm has, but not just the advantage, but the elements in terms of its unique competitive advantage, what I call the idiosyncratic elements. What identifies a firm from another firm in a manner that allows it to accomplish its goal is what is somehow tied in its business strategy. So we'll come to talk about that subsequently. But your strategy could be a cost reduction strategy. So you're looking at cost minimization. And then you have the advantage to produce at the level where competitors can't beat that price. So you focus on cost minimization. And that could be your competitive advantage. It could also be that price is not the factor, you're competing on quality. So you have the best talent, the best factories, and you can design a product that nobody can beat. So you also put yourself in that position where you differentiate yourself, product and service, that people cannot easily imitate it. But in all of this, what forms or what becomes a strategy really is a collection of actions and choices that businesses do. And that's what becomes long-term strategic perspective or strategic typology, as we're going to speak about it later. And that is an important part of a business. And because it's important, the argument we're trying to put out here is that if those collection of choices, those everyday business decisions, those sort of opportunity chasing and corporate strategy accomplishment that companies do because of the resources they have access to or the unique competitive advantage they hold, has any strong property in their operation, then it should impact other firm operations they get involved in. And that could be how they accomplish their sustainability targets or sustainability goals. So what we're saying here is that as a reflection, the business strategy will, in most certain ways, impact on ESG outcomes because the choices companies make will either increase or decrease their ESG performance because of the resources they deploy towards it. But one might argue that every firm would at least try to do something in that ESG realm. That is true. But it could also be that what they do will vary depending on where they sit on the spectrum. And I'll come to that shortly. Because, say, if you're in a business where your advantage is better to defend your territory, you might not want to spend too much money, discovering new ways of doing things or trying to innovate. You might spend more money protecting your market advantage, and you become a little bit defensive. And that becomes your strategy over a long time. And whether companies know it or not, all of these things play out as a consequence. So with their knowledge or without their knowledge, over time, as they allocate resource, as they commit to different decisions, they build a strategy that has significant impact on how their operations work, including their ESG operations or outcomes. So, to give a perspective as to what we'll be talking about, I want to pitch our research objective, or what we call the aim of this project. So, in this project, what we try to do here is to ask very important empirical question. But we start off by trying to look for what could be a linkage between that business strategy and ESG performance using a methodology that is established by Mice and Snow. I'll talk about Mice and Snow business strategy typology shortly. But if we hold that thought, what we're just trying to ask ourselves is if there is any sort of relationship between the business strategy and the collective decisions that an organization makes that would impact on its corporate sustainability practices. The answer might be yes, theoretically, and I can always see why that might be the case. But even if it's yes, there is a higher order or a second order question, which is, well, is this impact the same across? If not, which particular type of strategy will be more significant in terms of determining an optimum ESG outcome? And will that be at an aggregate level of the whole 3 ESG pillars, or will it be really at more specific granular components? We need to know that. And that's something we spend time doing. So to do that, we pose 2 research issues here, or we try to answer 2 questions. The first one is whether business strategy matters in the first place in terms of determining ESG performance. Now, if that first question leads us to a second one, which means if we get a very positive or affirmative answer, then a more likely good question to ask would be, in that case, what type of strategy type or what strategy typology will be of value to a manager? How should they kind of plan their business to accomplish maximum outcome using their strategy typology? But as usual, we're academics, and it's always good beyond the fact that we try to bring a very practical solution to the research problem. It's also good to inform it from a very strong theoretical and methodological perspective. So in terms of why this matters to us, it's the first fact that I'm not sure how much of us on the call are familiar with business strategy research, but one thing you will find is a very, very short supply of studies that really look into business strategy. I mean, to begin with, business strategy is a more management theory. In fact, more specifically, sits within organizational behavior. And in accounting and finance, it's building traction, but it's very limited. In fact, there's a recent paper by Habib, 2023, and it's on sort of the empirical literature review of different business strategy papers that have used archival studies in accounting and finance. And even at that, there isn't that much they could find. But what is even more interesting is even the papers that have tried to look at business strategy um, from accounting or finance background have actually focused on either one dimension of sustainability. So they may have either focused on only the social aspects or corporate social responsibility or environmental. Another thing I've noticed, which is interesting, of all the papers we went through, none was able to do not even a two-country study. So most of them focused more in terms of one jurisdiction. And I'm sure it's going to be purely because of data limitation, which we see a lot, or it's just because of how we instrumentalize, how we construct business strategy, which requires a little bit of some empirical processes I'll talk about shortly. But the key papers in the space that have even tried to look at business strategy and sustainability tend to be purely on one jurisdiction. There is one good paper by Kong et al. I think it's published in Business Strategy. No, that will be Journal of Business Ethics. And then we've got this other paper by Ho et al. And Maniora, all on US-based data. So Ho et al., Maniora, and Magarakis and Habib all focused on US-based data only. Now, that's not a bad thing to say, but the problem with that sort of one jurisdictional finding is that it limits generalizability. It reduces the ability for us to give people confidence to say, you can apply it in India or in Nigeria or in South Africa and get the same outcome. So for the value of empirical validation, it's good to test it in multiple perspectives. So we think we can bring that to, we can add that to the research body. And the next thing is a little bit of a conflicting conclusion. Not that there is so much of deviation in terms of findings, but it's interesting to find that there's a paper by Maniora which sort of looks at what strategy typology is more likely to mismanage sustainability issues. And they sort of found that prospectors will be the people to do that. I'll talk about prospector and defender strategy shortly. But Yuan et al. In 2020 sort of repeats a similar finding, but now they sort of conceptualize it in terms of, let's say if we ask a more different question, who is going to be more socially responsible in terms of the activities they do? And they found, well, this time around, prospectors are more socially responsible. Manera earlier found that prospectors don't tend to manage sustainability issues properly. In fact, in the Manera paper, the argument is that prospectors both intentionally and unintentionally mismanage sustainability issues, which kind of leaves us in the middle ground. And typically, in those theoretical, textbook rule of research is if you find a split decision, put your head there to see whether you get another answer. But I mean, whereas for us, it's not about settling the debate. It's more or less seeing whether there is still another thing we can find differently. So I'll do the last before the first. So let me give you a bit of a summary highlight as to what we found, and then I'll break down the detail of the thing. So the first thing is, with respect to whether business strategy matters or whether managerial decisions play out in terms of ESG performance, we found that to be the case. And it may look like very obvious, but for us, the finding was slightly different. We didn't just focus on the E, the S, or governance alone. We looked at business strategy as against its impact on the overall environmental, social, and governance performance of an organization. So, contrary to previous research that sort of worked it out from one of those perspectives, we will easily offer an incremental view of the fact that it plays out collectively. Of course, the impact is not the same across each of the ESG pillars, and I'll talk about that as we progress. But what is more unique for us is that we find the prospector strategy typology. Now, prospectors are those firms that are more aggressive in innovation. They are more, technology driven, or they are more future looking. They are more sort of ambitious in their approach to business or to product innovation or service innovation, we find them to be the ones that provide a better optimum result in terms of ESG activity. So for a business that is operating a prospector type strategy, they will be able to deliver more on their ESG outcome quicker than their defender equivalents. But I'll speak about this in detail. So that's the overview. And that's something we're still building. We are still building on additional results, and there are still a couple of findings we've updated to the paper. But overall, we still find consistency across. So what do we think we bring to the table in terms of contribution here academically? I guess the first thing is we are trying to provide for the first time what we call our first order evidence of the impact of business strategy on performance. Now, the other papers try to show how business strategy plays out, but not as a first order business, but like in terms of financial performance. But we focus on ESG directly with business strategy, and we see something there. Another thing is we try to also establish how the unintended consequences. Now, it's typical for a business manager to not to even determine their strategy type, but to just pick it up from resources available to them or competitive advantage available to them, only for them to realize later that there are unintended consequences of that strategy choice. And so what we're showing here for the first time is that if a manager is operating, a defender style or typology, they might need to be aware what could be the consequences of this typology on other factors that we may not be paying attention to. For example, our ESG performance. And so that's important. And we think that's a very critical finding because if the IFRS mandates, as we see, is spreading around the globe, is becoming a mandate, then companies across the world will be required to either comply or be fined. And we think it's good evidence they have that knowledge early. And while I'm talking about that, we're still thinking about we're working on understanding how businesses and decision makers are receiving the recently released ISSB standard. And Neerav, if you can drop the link, and I will be happy to hear from those of you on the call. We'll drop a link of a survey briefly. If you can just click on that survey while the presentation is going on and leave your thoughts, I'll much appreciate it. And I'll talk about that at the end. So we show also how different pillars of the ESG, what are the E, the S, and we go further to combine the E and the S, can be impacted by the strategy typology. And then we sort of provide what could be the optimum approach. And I'll talk about more of this towards the end. So let's go into some details here. So business strategy and the typology. Like I said, we conceptualize business strategy based on what we call the business level strategy. Now, in the literature, there is a business level strategy, which is how a business really operates within its industry. And there is the overarching, what you might call industry level strategy, which is that decision of whether a business wants to be in a specific industry. Say, for example, a business might choose to say, we want to operate in the petroleum industry, or they want to be in the textile industry. It's a choice. So that's an industry thing. But if they find themselves now, say, in the textile industry, they need to be able to set their unique idiosyncratic elements that will differentiate them from other companies in the same textile industry. How do they accomplish that? They have to compete on what we call their own unique elements. And as I'll come to talk about it shortly, the resource-based theory also provides incremental understanding as to how companies can use their unique resources to to carve for themselves a niche or an advantage in the market. So different theories and measures have been used in business strategy, and Most of them come from organizational behavior or management theories. A very classical ones people may remember is the Porter method. And the Porter method, we talk about it a lot. So Porter sort of conceptualized strategy from cost and product differentiation purely. So you're either competing in the market by producing the cheapest product possible, or you're producing the most differentiated product. So if you wanted to buy a wristwatch, you probably know that buying a Rolex is not because you're looking for the cheapest product. It's a differentiator. You're looking for something that sets you apart. And people who buy Rolex don't worry about the price. They just want a good one. But if you just wanted to check what time it is, you buy the cheapest possible clock, cheapest possible watch you can find. So it serves the same purpose, but it's a question of differentiation. But over time, there's a bit of quality differentiation that also determines how long that product will serve you. Now, March 1991 also operationalized business strategy more from whether the business is kind of building more learning into its business style. So if it's exploring, seeking new opportunities, or it's exploiting, staying where it has built advantage and just continue to dig more, it could be the choice. And then there is the Tracy and Waisama 1995 approach, which kind of builds, three perspective around whether you talk about operational leadership, product leadership, or customer intimacy. Now, all of these strategy typologies or strategy types exist. The problem with strategy type, there is even a new one. I was listening to a talk by, I'll pick up this guy's name. He's in MIT, and he's also come up with his pyramid style of strategy. Well, it's not the absence of strategy types that matters. Sometimes it's operationalizing it and measuring it, which I'll explain shortly why it becomes difficult to choose which to use. Mostly, some might require you to use solver instrument, but if you want to use archival data, then you're limited to choice. And that's why Miles and Snow is perhaps about the best you can find if you want to use an archival-based data, or what we call an accounting-based information. So Miles and Snow 1978 offers us a typology that you can use because of several advantages. And it's perhaps the most popular one I've seen in the literature, and in fact the most used one, the only used one, in fact, in accounting and finance. Bentley et al. 2013 published a paper in Contemporary Accounting Review, CAR, and I think that was a very good paper that sort of first depicts how we can operationalize it. And ever since then, there's been a bit of a build-up, but I think the Bentley et al. Paper was more looking at it from it could be tax aggressiveness. And then Habib and Hassan 2020 Higgins, it could also be the Higgins et al. Paper. And all of this paper, all of them provide a different way of kind of thinking about how the strategy typology can impact business choices. But none of this really bring it close to the sustainability issue. But so what does the Mice and Slow tell us? Mice and Slow kind of depict strategy across majorly four continents, but one of it never shows up in the literature often because they're called reactors. So Mice and Slow just believes, these people don't have any style of strategy. And so they kind of focus on the three very important ones, which are the prospectors, defenders, and analyzers. And so if you put it on a continuum, on a straight line, one from one extreme and another from the other extreme, what you're going to find is prospectors somewhere here and defenders at the end. In the middle will be the analyzers. And prospectors, by their characteristics, you will find them to be very innovation driven. They try to put dynamism into business. They try to look for new ways of doing things, design their product. They want to be market leaders in terms of changing continuously because they want to explore, and they invest into research and development significantly to do things like that. Now, if you flip it to the extreme end, you're going to get defenders. What they do? Well, defenders just try to hold their market. They figure out we've got this. We want to be stable. We want to build a consistent market advantage because we already have it. So they become more cost efficient. So they spend more time thinking about how we're going to do the same thing we do, but doing it better, more efficient, more faster, more cheaper. Not so much about really how we're going to do something different, how we're going to, sort of go, as we call it, disrupt the market. But disruptors, you're going to find them more within the prospectors. And then we've got analyzers, which is a little bit of either of both. So analyzers are very much in the middle. From time to time, they may reflect prospector style, and then other times defender style. They don't give us a very clear empirical based test. So that's why most times we keep the test at the two extreme. But in most data set I've seen, you'll find more analyzers than you find more prospectors. Now, people ask this question. From time to time, companies can actually switch. The answer is true. But if you think about strategy as a long-term consequence of your investments, then we don't see that switch in anything less than a 5 years period or more. And we're going to show how we operationalize that in terms of how we measure our data. So why do we choose miles and snow? Very typical question I get all the time. The answer is simple. It offers us the best theoretical and empirical appropriateness for our investigation. We want to see sort of behavioral pattern across accounting-based data, and we can't operationalize this using any of the previous methods that I've just mentioned, whether it is the Marsh 1991 or Porter 1980, or even the Wasama 1995 method. None of those strategy type sort of build into them the ability to operationalize it using archival data. So that limits the ability to use it. Again, it aligns with the two key theories we employ in this study, which is the stakeholder theory and the resource-based theory, because it offers us a chance to use the information available in a business data to see how they've been spending money or the things they've put more resource to. And that can tell us how their strategy type has evolved over the years. Another very important thing is the fact that we are very much in that scientific era of research where we want replicability. So we would like somebody to retest our evidence and find it consistent or counter it in a manner that is empirically valid. So we employ a data set that is publicly available and people can see. Now, I'll quickly gloss through this. In terms of the prior literature, one of the things that is very typical is that there's a lot of story out there as to how strategy can be of value. More importantly, how it is integrated into ESG. And we kind of think it's a good time to talk about it more because with ESG or broader sustainability issues becoming really big consequential matters, then no time than now to think about a research that will help us clearly see the effect of ESG or the effect of business strategies on ESG outcomes. So we went through to see what is there, and there's quite a few very limited papers that have tried to, make an attempt to even look at the relationship between ESG outcome and business strategy, the relationship. So while we believe there is a link, theoretically, it's still a matter of empirical validation. So whether business strategy influences a firm's or company's holistic ESG outcome, and which typology delivers the most outcome, the best value, is still a matter of an empirical question. So it's a matter of empirical debate. So we think we want to get into that space to see if we can answer it. And so we pose two very important hypotheses. The first one we argue based on the stakeholder philosophical thinking. And well, what does it say? Classic Friedman 1994, Jensen et al., Sang 2023. We also contribute to that space in a recent paper, the Helia Code and Code 2024. The position is very classic. Every business will try to do anything that will make their stakeholder feel good about them. The people who pay you are the people you are trying to meet their needs. So what happens normally, traditionally, businesses will, as much as possible, try to satisfy their stakeholders. So if stakeholders say we're interested in ESG, then businesses will do it. So if that theory holds, which typically it's been well tested, then we expect that businesses will try to do good because that is the only way stakeholders will find them valuable, especially if they know that's the way to win more market or more revenue. So our empirical prediction in that sense is that if business strategy, as we argue, is really a critical success factor, then what we should see is that there's a well-established relationship between a firm's business strategy and its ESG performance. All factors held constant, and that's what we test first. But like we said, that question, although empirical, may lend itself to very natural intuition to say, well, why not? But we go beyond that. We say the most important question for us then is the secondary order question. Now, if business strategy matters, which one should a manager pay more attention to? And that's the question we started with. So now this lends us to, or this lends itself to a new theory, because now if you take stakeholder theory, which is, yes, your stakeholders want you to do this, but the problem is you can only do what you have the ability to do because of either the natural resource you've been endowed with or the resources you can develop based on what we can call the advantages, your competitive advantage. And that is purely what the resource-based theory explains. Now, within the resource-based theory, firms differentiate themselves based on what they have that others don't have. It could be the talent you hire. It could be the location you operate in. It could be the access to capital your competitors don't have. Now, all of these things combined give you an advantage that not many people in the market can get. And because of that, we believe that a business strategy will not deliver the same outcome across the board. So it's going to be heterogeneous. But if it's heterogeneous, how do we know who on the continuum gets what and what drives it? And so we kind of dip ourselves a little bit, we dig a little bit deeper here. So basically, the assumption here is that firms compete based on resources. Now, the resource could be tangible or intangible. Now, most intangible resource could even be the brand. You know, an Apple brand is worth something more in some places and mostly global than what what's another equivalent competitor, maybe Samsung or Oppo phone or even Techno. So an Apple brand has an intangible asset it carries with it. So that's a resource. Now, how that resource is put together by the business to take advantage of its market is another thing. So we can look at that from how it uses that to deliver on its ESG outcome. So collectively, in line with the resource-based perspective, we think by the nature of prospectors, they will be the ones who might have those extra resources to play with because they are very aggressive, they are very innovative. So they might have both tangible and intangible resource that will sort of drive their innovative capabilities in a manner that their rivals cannot imitate. And through that sort of actions, they may be able to deliver better ESG outcome than their other typologies, which could be analyzers and defenders. And there are other sort of theoretical expectation here, because for instance, defenders will be more prudent in cost and trying to minimize their costs in everything they do, whereas at the extreme end, prospectors will be very open to new ideas, and where they can fund it, they wouldn't hold back. So they can fund business ideas that will lead them into breakthroughs in terms of how they reduce their carbon footprints or investment in cleaner technology to improve their business processes. So they will take more risk technically that can deliver better ESG outcome compared to other typologies. But that's very hypothetical. We will need to see how that plays out in an empirical test. And so our second hypothesis really is that the association between business strategy typology and ESG performance is stronger or strongest for prospective firms. So what did we do data-wise? We pulled our data from Refinitiv. If you're familiar with the database, it collects ESG data. But because of how the strategy typology is constructed, we will need 5 years prior years or 5 years pre the starting time rolling average to be able to construct our variable. So I'll talk about that shortly. But we ended up with about 5,000. Now that sample has changed. I think we have updated our sample to 2022, just still working on it. I don't want to conflict the two results, so I'm just reporting on the one we have at the moment. So we've got into about 6,000 plus in the end. And I think while our sample firm year observation has gone up, the number of countries in the sample do have dropped from 45, but it's still very much at a global sample. And because it's a country level, or it's a multi-country study, we applied some country level controls and we chose the World Bank Development Index, which we sort of aggregated and use a PCA to test. To aggregate it to just one single measure and throw it into the model. So how do we measure our miles and snow strategy typologies? So 6 major variables are used based on 5 years rolling average. The first one is the ratio of research and development to sales. Now that's very important. We don't need to explain that much of it, but it's a very good literature area to read on. But if you think about the best way to measure innovation is to look at the investment the company is making in research and development. And if we take absolute number, it's not going to be appropriate. So you've got to scale it to something. So we scale them to scale so that it's proportional to revenue. Now I've seen other research where I think what I see sometimes, people might say they use patents as a sort of proxy for innovation. That's also fine, but you may not find that sort of patent or what you call goodwill on every business balance sheet. So you may not be able to have a comparable measure depending on the industry. But investment in R&D tends to be very typical. And the other ones are typical things as well. We took ratio of employees to sales, change in total revenue. The literature suggests that one thing with prospectors is that because of how they're very innovative, fast lean, very performance driven, very aggressive, they tend to have very high ratio of turnover. So it's good to see how employees are leaving those companies. So those are also one good way to understand what kind of strategy is the company playing. If they have more people leaving or they leave too quickly, that's a thing to put an eye on. And then there is also sort of a change in total revenue. We looked at ratio of selling to general expenses, employee fluctuation, capital intensity. Interestingly, capital intensity is the one we inverse, because with capital intensity, you will notice that the more capital intensive a business is, the more really it's defending its territory. So they will hold more property, plant, and equipment, and so we'll find more defenders there. So what we did was we quantile ranked these measures, and such that we had the highest and lowest quantile to represent 1 and 5, and that's where you have the two extremes. Because we have to apply the rule based on how the theory is defined, the first category, which you will see the lower end there, which is 6 to 12, will be defenders, and then 13 to 23 will be analyzers, and 24 to 30 is a top prospectus. Now, you might ask, what happens before 0 to 5? Now, Miles and Slow says there's this group of people, reactors, who really don't count. You just can't make any sense with them. So theoretically, we don't tend to test them. And most papers will only focus on the two extreme because that's where you really get perspectives. Okay. And then the ESG measure, Refinitiv, very classic. We talked about it. But nevertheless, as with every database, Refinitiv has a very strong critique because one problem people talk about it is that it may have shortcomings because of revision of the numbers. So over time, before it is locked, is only after 5 years, or maybe I think 5 years, I think, from the last time I checked. Because Refinitiv can keep changing, revising scores. As they find more information that is material, they may change what they rate a company in terms of its ESG performance. But that is not a problem to us. And in fact, we did a very important sensitivity analysis here, which we try to benchmark companies in our prospector category and companies in our defender category. We try to benchmark their Refinitiv score with their S&P 500, S&P Global ESG score. So, and we find qualitatively similar results. What we did, for example, is say, if HP Computers is a prospector, like it is in our sample, it has a score maybe 95 on Refinitiv or 85 total score. We will go to the S&P to see where it is ranked. And if it's ranked in the upper band, which is true, about 84, 85, then you see it's qualitatively in the same parameter. Although they don't score the same numbers because the measurement methods are different, but you see they are all classed in the A category. So that gave some confidence that we're looking at the same thing. And I think we had AstraZeneca in the same category, which was in the sample. We did those sort of tests. So this is a very, very basic, I wouldn't call it a parsimonious model, but it's a very standard model where we sort of test these two hypotheses with. Basically, all we do here is to say, well, we should expect that the business strategy of a company would have significant effect on its performance and holding other constant factors. So we kind of controlled for different firm level factors, which we denote there as X, and from firm size to leverage, profitability, a few other measures there. But again, because it's a cross-country test, we also have to control for industry factors. Country level factor, and which we also include there. In addition, we run all our models based on industry fixed effect and year fixed effect. So I did put out the summarized result, but here's the detail, just in case. This is a description of our data. So the data in terms of the distribution, what you will see is analyzers constitute the largest. Interestingly, we still have prospectors as the always smaller part. This is qualitatively similar with most of the strategy sample I've seen. You will see the analyzers have the most, but they still don't tell us a very strong empirical issue. And so we focus on the defenders and the prospectors. In terms of our industry classification, we had, I think the most were from tech industry. This will change with our newly revised data, but just similarly slight movement here and there, but overall is the same. Interestingly, you will see that for the tech companies, majority of them will be in the prospector level. And then we'll see that they still have some analyzers and they have defenders. And it doesn't really matter. It doesn't say anything per se. It just depends on Some businesses, when they reach one level, they have to protect their territories or they switch to defenders. But in the health sector, we notice also, you see, most of them are actually prospectors, and you might find very little defenders. So, in terms of the first hypothesis, which is, does business strategy and ESG performance have anything in relation? The answer is yes. And what we did here is just to run the test. And what we found is that truly, as you can see, taking ESG as a whole, there is a very strong statistically significant relationship, and that's at the 1% level, which is very strong, that a business strategy that a business, whatever business strategy a business chooses, whether it's analyzer, whether it's defender or prospector, will play a role in the kind of outcome they get in their ESG. So that's a general view. That's well sorted. And when we break it down, we see this is stronger for the environmental pillar, or what you might call the environmental component of the ESG. There is still a strong effect for social part, but we don't see much in governance. And one of the things we explain is that in the last 2 decades, since the Sarbanes-Oxley Act and all the corporate governance code have intensified, there's almost like a well-established norm in terms of governance that you see around businesses, and there's a lot of codes and compliance. So not much is showing up because it could be that there's no variation significantly within industry. So take, for example, in a banking sector, all the banks will at least apply a very similar code of governance, corporate governance code. And so you may not find that much of variation. So this is not saying, although the sign goes negative, but there is really no statistical significance, so nothing to explain in that sense. And then when we go to the strategy typologies, you can now see, so we split it, we put the prospectors and we run defenders. What do we see? Defenders are coming up strong. Sorry, prospectors are coming up strong. So whether it is the aggregate ESG, prospectors are the ones really that will be driving more of the ESG outcome compared to defenders. And we see a similar pattern. But if we now look at which effects, of course, both of them are statistically significant at the same level, but in terms of the coefficient, you might see that when it comes to the typologies, then prospectors will deliver even more on the social pillar. Per every unit of change, you will find more effect for the social pillar than there is in the environmental pillar. Now, of course, the governance is positive, but it's not significant, so we don't say anything about it. So the second question also is answered by saying prospectors, and very much aligned with the theorization of resource-based theory, will be more tracking towards a differentiated approach than defenders. And that's about the main results, but we do have a bit of robustness. I wouldn't bother you too much about it. So we change our strategy typology. So we change our measure of strategy here. Currently in this test, we used a discrete measure. And then we come here, we use sort of an ordinal approach where we kind of code strategy typology based on 1, 2, 3, respectively, if it is a defender, analyzer, or prospector. And we still find consistent results. Now we decided to say, well, it seems like there is this stronger effect for the E and the S. And that's something we don't see in previous research. Most previous study will either do E separate or they do S. They've never had the chance to do both in one research. So we decided to run both. combined. So what happens if a business wants to focus on the ones that are more stronger for it? Business strategy overall still makes significant effect for environmental and social issues, and it is still stronger for prospectors. Now, defenders are even beginning to go negative, but at a 10% margin is a bit of a tight one. But again, in the end, if you're a defender typology, then you need to start thinking, how do we sort of realign or align if ESG mandates come our way? And I guess that's for us the most important thing. Additional tests, I'll just keep all of this. These are just, we split the sample across high emitting firms versus low emitting firms. And this is interesting because even if you're a high emitter, it's interesting that you could still, with a prospectus strategy, mitigate or still deliver on your ESG outcome. In fact, it's so interesting that at that point, your governance effect begins to peak. And one of the things we argue or we see here is governance would likely peak for high emitters because if you're high emitting, it means you are very poor in your environmental performance. So you see the environmental performance is not significant. But then in compensating for that, most companies might be investing more in their governance strategy and in their social outcome. And that itself might give them that advantage they miss in those other environmental advantage. Okay, there's so many things we don't report here. We've carried out several other tests, partly in line with some of the comments we've got from previous reviews, and that's still ongoing. So we've done several other tests now, including entropy balancing, propensity score match sample, just to see the different things, and test for endogeneity across the sample with 2 least square. So there's quite a few things going, but I guess for us, it's to have that conversation to say, really, is this a matter of importance? And we think empirically we find that to be yes. So we find a positive association between business strategy and ESG performance. And we see that specifically that a firm's business strategy on average would influence its ESG performance up to 0.8%, all things being equal. So that's, depending on how big the business is, that can be something that is strategically valuable. We also find that the strategic choice you make as a business will play out stronger in terms of consequences for your environmental and social performance. And if we look at them, those are the areas where most standard setters are spending their time to do a bit of due diligence, because that's the 2 areas where there isn't much in terms of standard and governance. And the prospector typology is really the one that sort of provides that superior ESG outcome. So what is the takeaway? And this is where I close now. Now, for us, it's a practical thing, and we think managers should pay attention. Not just managers, regulators, and even fund managers. But let's start with managers. The first thing is, we've tried to document that at least strategic orientation matter. And the investing choices businesses do over time plays a part in either differentiating them or not. And in that differentiation strategy, it will play out in terms of how they perform better or less with respect to ESG outcomes. So managers that would like to improve their ESG performance, especially in response to their stakeholders' demand, need to pay attention to which type of strategy they are playing with. If they're lucky to be on the prospector type, that's fine. It's to intensify it. If not, then it's time to start thinking, how do we sort of pivot or realign? So our findings, we believe it's valuable, particularly when it comes to resource allocation and decision making that will impact ESG performance. So if you're a business manager and you're thinking about investing or decarbonizing, then you want to think about, well, where do we put the money directly into to get the significant value we want for our ESG performance? And we believe, following the release of the IFRS sustainability standards, that managers in areas where these standards will become mandatory will need to, and in some jurisdiction, by the way, ESG is already a mandated thing, but at what level? Maybe at different thresholds. So they need to be able to understand how to either align or realign. Also, one thing we've figured out is adopting a business strategy is consequential on competencies and resources available to an organization. That's true. And that's where the natural theory of the resource-based theory kicks in. But the problem, though, is it's not whether you are worried very much about your natural or your differentiated resource. It's whether you know what that resource leads you to. So that is where we speak about the unintended consequences. So you may not know, or you may know, and we think this research provides that incremental insight to say this might be something you want to think carefully when you choose, or even if you have not chosen, when you apply your operations, you need to think about how these things all play out. And again, we feel for investors, fund managers, this will be useful. And like I said, if you're still here with me, which I think you're still, and you haven't completed the survey, feel free now to kind of scan the QR code. We will be happy to hear from you what you think, because that will be a good way for us to also hear more of those perspectives. Thank you, Neerav. I'm sure I have not wasted too much of your time, but hopefully happy to take questions now.
Yes, thanks a lot, Dr. Moses. I'll now request the audience to, please go ahead with your questions. There are two options. Either you can raise your hand or you can use the Q&A tab to send your questions. I repeat, either you can raise your hand or you can send your questions through Q&A tab. Okay. I'll wait for a few minutes. Professor Sugatan?
No, I just wanted to say thank you to Professor Moses. Very interesting, association between strategy typologies and ESG performance. I just wanted, his quick views on, the evolving, especially that first table which he showed, that there is very little relationship that he's able to find between governance per se. I mean, is there a thinking behind why or why not you've thought of any mechanism? Is it a measurement issue? Because governance within ESG is sort of, definitive, measures it in a certain way. And, compared to what we typically call corporate governance. So your views on that, yeah.
No, thank you so much. In fact, we've been cracking our head on that. And when it comes to measurement, we've been testing different ways. I think maybe one thing that may play out will be the construct of the metrics. And again, that's where I see the very slow uptake in business strategy using this method. If you don't have that much of a data sample to put that 5 years rolling average. But again, we also feel, given that we are tightening the sample to a very specific issues, then the ones that do not have variability significantly across the industry may not show up, because that's what the business strategy measure actually would do. Because we're actually running those 5 years rolling average across firms in the same industry. So the likelihood of what is not varying among them will not show up any differentials. We suspect that. But I guess it's still open to more testing, and we'll try to see what we can do more.
Okay, so we are still waiting for a few questions. So participants, you can also use the chat tab to send your questions. In the meantime, I think I have a question, Dr. Moses. So I was looking at an interesting graph you showed, where there was a description of the strategy. Yeah. So here, given, this one. So when you were talking about, under miles and slow methodology where you were using R&D and capital intensity to measure the strategy. Now, it immediately came to my mind, like we would expect tech industries to spend more on R&D, and they would have more intangible investments, while the energy industry would have more tangible investments, right? In huge, very expensive fixed and tangible assets, right? So even though I think you have controls for you're controlling for the industries, right? Industry fixed.
Yes.
I
Yeah,
think I think that what you are capturing, the strategy in a way is capturing the industry, right? So tech industries are, say, for example, more likely to come under prospectors, while the industries like energy are more likely to come and defend us because they'll be more capital intensive. And this might have, and so that's the first point. The second one is this might have also have association with the ESG performance because the energy industry is likely to have more emissions, while tech industry may not have that much. So I thought, get your response on this.
No, very, very good point. And that has come up in a question. This is well, so we sort of try to deal with the endogeneity problem, whether there is already some elements within the strategy measure in trying to construct that six variables into an index, whether some of it were already captured in the ESG measure. And we did the very classical endogeneity tests, but we've even gone further to do entropy balancing and PCM, propensity score matching to split and see. But you're very correct. In fact, the theory suggests that somehow, by the way the characteristics of the typologies define them, some industry will have more people in that typology than other just by the nature of their business. It's also something we can't run away from. But because what we try to do, we control them within industry, we are assuming that, say, for example, if you look at the tech now, although most of them are prospectors, but there are still defenders in the tech industry, 15%. This is percentage. So what is saying there is that while the most of the people there, but there are still tech industry people who may have reached the point of maturity, and they might be saying we're cutting down on maybe R&D, we're cutting down on those sort of aggressive marketing, but we're trying to hold our solid space in what we already have. So you might see that. It's a funny one when we come to health. We just noticed that literally almost near zero, nobody is defending in the health industry because, again, if you think of most of the companies in health would be biotech companies, sorry, and they are more constantly trying to be in the factory or labs, trying to do new vaccine or trying to think about new products. So their R&D cost will be always very high. And so that might also play an effect. That's why we see that. But I agree with you, Neerav. It's almost like the limitation we can't run away from. But it's the best we can do is to control or treat it because it's the risk. Just because of how the industry is, the nature of the industry will also determine the nature of the cost they incur. Transport's true. But what again you will notice in transport, we'll see, because it's industry peer, we're going to see within the same industry who are the people who are investing more in cleaner technology compared to their peers. So you might pick better players than others. Because if we try to do, say, tech versus maybe health or tech, then you see, at that level, if you control it at that level, then you're going to have a problem because they don't play by the same rules, especially financials versus non-financials.
I think there is one more way in which, suppose in your calculation of strategy, if you use industry adjusted R&D or industry adjusted employee number and capital intensity. So I guess this picture would change a bit.
Okay, I'll try that as well. Maybe we can do that as a robot. Yes. That's a good one. We can do industry adjusted.
Yes.
I mean, like I was saying earlier, one other thing I have seen in the papers, but I don't know whether we have enough data to do that. It may not be the same for all industries to use patents, like patents as a measure, then that will even be better but the problem is, I wonder whether a real estate will have a patent. They don't. So we're going to see patents in technology, in health, maybe in some industrials, but that's about it.
Okay.
So it becomes a trade-off of some have it, some don't. But I'll take that. I've just noted that industry adjusted R&D or industry adjusted measure will also be good.
So I guess I don't see any questions from anybody else. So
okay.
Yeah.
That's good. Like they say in academics, if as a teacher, if no question is either you've taught very well or you've confused everybody that they don't even know what to ask you. So maybe it's the first one.
So yeah, please go ahead.
No, I just wanted to say thank you for the opportunity. And I think we're excited about the work when it's fully developed, fully ready to go out. We might be in touch again to see.
So again, on behalf of the Arun Duggal Centre for Research on ESG, I really thank you, Dr. Moses, for taking time out. It must be around 10 o'clock in the night in New Zealand.
Yeah, not too bad. Good time.
Not a good time, but thanks a lot. Again, from me, Professor Sugathan, and all of us at the center and IIMA, thanks a lot and hope to see you soon. And thank you all the attendees
All right,
for being here. Yeah.
Yeah, thank you, Anish. Thank you, Miss Suganya, for all the email and the support. Appreciate it. Who knows? I might be with you people in the December conference. So let's wait and see.
That's right.
Okay then.
Thank you.
Bye. Yeah.